to start. Okay, it sounds like we're recording. Do you have everyone populating there, Stephen?
Yeah, it's starting to come in. Hello, everybody. It's funny, it's adding them.
Yeah, slowly adding them, so.
It's weird, yeah.
Okay, listen, why don't we just jump in here, guys? Thanks everyone, for Dave, first of all, for joining us here today, and everyone on the call to sort of talk about, everyone knows Dave here from running Honeywell and his outperformance over the S&P over the 16 plus years there, and prior to that, the appliances division at GE, and we became shareholders at Vertiv fairly quickly after you consummated the transaction in February of last year. And once the book Winning Now, Winning Later came out, it's really quite a different and better book than most of the other business and self-help kind of books out there. So big thank you for putting the playbook out there on how to manage dualities in the workplace. And while I think most of the participants know you, I wanted, before we jump into the book, I want to ask a question about your upbringing. And I think it's really instructive to hear that background because it's certainly unique. It's not what people would expect. And without leading the witness too much, my question sort of is, does there have to be an element of adversity to the early stages of your life to breed, leadership strength?
Wow, that's an interesting question. I mean, my leaning would be to say, I think it helps, but I also don't think that without it, you can't become a great leader. I think it helps just because you develop early on a hunger that maybe others don't, if you haven't grown up with it, you don't recognize. And I still tell the story about, I can remember being like 11 years old and my friends and I all heading to the little general store that existed because they were all going to buy popsicles. And the five of them all bought a popsicle and I had to sit there watching them have their popsicle because I didn't have a nickel. And that always stuck with me. And I just said, this is not how I want to live my life. I don't want to be like this. And you go through those sort of stories enough and having to work for things if you wanted them. And I think the adversity does help. My background was a little different to your point because I was the first one to graduate from high school in my family. My dad had 6 months, my mom had 2 days. So I was the first to graduate from high school. Not a lot of role models, just this kind of French-Canadian enclave, mill town in New Hampshire. Not a lot of role models, nobody that you could look to and say, okay, well, that's what's possible someday. And I was really kind of a screw off. I was good at school and that helped. And it took me 6 years to get through college because I quit twice because I just hated it. And I was good at it, but I just didn't like it. Quit to become a mechanic and a carpenter. Then I quit again to become a commercial fisherman. And took me 6 years to finish. My second semester, my junior year, I got a 1.8. After my sophomore year, I was called in front of the assistant dean of students and told I'd no longer be allowed to live on campus because I was just a general troublemaker and wherever I was, there was trouble. So, which you could tell I'm still kind of proud of, but it was not a great beginning. What changed my future was I got married, and I got married just because all my friends were, and it seemed like a thing to do. We're living in this third floor, unheated apartment, uninsulated apartment in New Hampshire. So it gives you a sense of how chilly it can be. And my wife comes home and tells me that she's pregnant and that she can't work anymore. And I do the math, and I'm an hourly employee running a punch press at a GE plant. And I did the math and realized I was spending $2 a week more than I was making. And I had $100 in the bank. So I figured, okay, I've got 50 weeks to figure out what to do. And that's when I went back to school and just kind of really started to focus. I went to school days and work nights. And I always tell my oldest son that he's the reason that I'm successful because he scared the bejesus out of me. Absolutely scared me to death. And I remember taping up the windows so the breeze wouldn't move the curtains anymore, because I was afraid my kid was going to die because I was a screw off. And once I started to get into business, I surprised myself by, one, how much I liked it, and two, that I was actually kind of good at it. So it was kind of ended up being mutually reinforcing.
I just want to
Right.
ask Dave, I'm sorry, Chris, to interrupt. Dave, you seem like a really nice guy on the outside. I mean, sort of everybody's best friend sort of thing. Like, kind of like Chris here. Everyone wants to have a beer with Chris. But I'm wondering, so it sounds like your motivation for success was sort of getting scared the bejesus out of, right? How do you motivate Rob, your managers, without scaring the bejesus out of them?
Well, I'd say the first thing is to make sure that you have people who want to be motivated. And if you have somebody who just doesn't care all that much, or
Sure.
it's just a job, there's there's this old saying that says it's easier to take a little wind out of someone's sails than it is to put it in there in the first place. So you got to find people who, let's say, have some wind in their sails and really want to do something different. Then I'd say it's a combination. And this whole idea that people have, like it's all incentives, or it's all fear, both of those are wrong. It's carrots and sticks, and people are different. And I've had people where I've had to call them in my office and say, I want you to know I'm hitting you with a 2x4, and I'm telling you I'm hitting you with a 2x4 because you seem impervious to suggestion. And this is the only way I can get your attention. And I need you to do something different. And here's what it is. And they'll sit there in a state of shock saying, oh, well, geez, I had no idea it was that bad. There are others where all I would have to say is something like, you're capable of better work than this. And man, they would internalize that, and it would have a big effect on them. So it's important to understand what's important to people and how are they going to internalize your message. And too many leaders I've seen feel like, okay, well, this is my leadership style, I expect people to adapt.
Yeah.
Which can work if you have all people who respond to that style. But if you say, no, I really want to get the best performance out of every single individual, then you need to understand how those individuals react to things. And people are different. So you have to learn what is going to move them along. The thing I have found is a sense of humor about things does make a difference. And if you can get a tough message across, but do it in a way where people are kind of laughing a bit afterwards and going, yeah, okay, that's right. I could do a lot better here.
For sure.
Then
Yeah.
that goes a long way. You can't use it 100% of the time, like I said, because there are some people that are only going to respond if you truly get angry. But in general, having a sense of humor about things so that people can internalize the message without it damaging their ego and their sense of who they are and their sense of self makes a difference.
And the follow-on for me there, though, was this a bit of trial and error for you in understanding how to manage people, or maybe was it some of your experience at GE that led you to understand better how to interact with those folks to get them motivated?
All those things make a difference. So, I mean, all of us grow up a certain way. We know what motivates us. There's a tendency to think everybody else is the same way. It takes you a while to learn that's not the case. The GE mentality was very much one of, the boss makes a decision, everybody executes, which works as long as the boss makes great decisions, which you can't count on. So I would say in the beginning, I was more of a hard ass than I ended up being once I realized that it was possible to be resolute about what you needed done, but that there was a different way of motivating people. It didn't have to just be that one approach to everything. So yes, there's no doubt there's a maturation process.
Right. And from our conversations, even just a few minutes here and reading your stuff, I mean, there's definitely an element of an independent streak in you, sort of going against the grain necessarily. And so, many would say they wouldn't have taken on such a sizable challenge as Honeywell, but how do you enforce that independent view, not just for yourself, but also for others that are at the executive, at the board level? And how do you sort of, push forward independent thought, throughout an organization to challenge, the status quo?
Well, I'd say the first thing to recognize is that independent thinking is more rare than being smart. And there's a lot of smart people. They do well in school. They do well on tests because you're just kind of writing out what somebody has already taught you and proven that you internalized it. That doesn't mean, though, that you can take kind of a separate set of facts or circumstances or look at an analysis and come to a different conclusion. And that's something that I think needs to be developed early on. And I credit both my parents, and I've said this many times when I've been asked, okay, who is your leadership role model? Who would you look to and say, this is where I learned most of my leadership lessons? And I always say the same thing, it's my mom and dad. And if you just, in general, if most people just kind of internalize the lessons their mom and dad gave them, they'd find it works pretty well in the adult world also. And my dad used to always say, be a leader, not a follower. My mom used to say, if your friends jump off a bridge, are you going to jump off a bridge? And it's really irritating to keep hearing that when you're a kid. But it does make a difference over time. So I think you got to try to find people who are already there. If you have people who are just smart, but can explain why it is the way it is and why you have to think about things this way, well, the chances of getting independent thinking from them is probably not really likely. If you have some people who, let's say, are on the edge of that and could do it, the best thing to do is run your meetings in a way where people have to think independently. And that's why, if you noticed, I spent a lot of time talking about how to run meetings. And as a leader, we all grow up usually starting as an individual contributor, where it's our job to do the analysis, develop a point of view, then advocate. Well, the higher up you go, the less you know about every single topic. It's just impossible to know everything. So if you still want to make good decisions, your job now is to figure out, how do I get all the facts, all the opinions on the table with nobody has a preconceived notion about, okay, here's what the boss wants to do or where he or she's going to lean. Well, you need to run your meetings differently. And the way I described it is, as a leader, you want to be right at the end of the meeting, not at the beginning of the meeting, which has a lot of significance, because if you say, okay, that's what I want to do, and I want to get the facts and opinions, means you need to go into the meeting without anybody really knowing exactly which way you're leaning. And you have to be very careful to mask that in the discussion. And in the discussion, you need to make sure that everybody who is in that meeting speaks up, and that you turn to them and say, what do you think? And you end up learning introverts and extroverts participate differently. Men and women participate differently. So how do you make sure that you're actually encouraging them to take the time to talk? Then when I would get to the end and everything was out on the table, I still wouldn't declare anything. And I'd start with the most junior person in the room and say, okay, what do you think I ought to do? And it's fascinating to watch when you first start it, because the first thing they do is look at their boss. And their boss generally goes to interrupt and answer for them. And I'd always put out my hand and say, no, I'll get to you. I want to know what this person thinks. And I'd work my way around the table from the most junior to the most senior in terms of most involved in whatever the issue was, and get from them, what did they think I ought to do? And once I had all that, I figured, okay, now I've got enough to create a mosaic. And I always called it a mosaic, not a painting, because it's not as pretty as a painting, but you're kind of fitting all the pieces in together to arrive at what's the right solution. And then I would explain it. And I because there's a lot of people who feel like, well, he obviously doesn't listen. And what they mean is he didn't agree with me. And there's a big difference between listening and agreeing. And I would explain the decision so that those people with whom I disagreed would understand that there were no ramifications from that disagreement, because I really did want to know what they wanted to think, but that I disagreed and why. so that they understood that there was a rationale behind it. You do that enough, and you do it over enough of a period of time, then you start to encourage those people who, let's say, might have at least a bit of a proclivity to want to think independently. Well, now they have to start doing it because they think, okay, I'm going to be asked in the meeting, I better have a point of view. But like with anything else, you have to be careful of the counter reaction, because if you're, say, the finance leader, the last thing you want to see in a meeting is dissension in your team in front of the boss. So what do? You start having a pre-meeting to say, okay, what's the collective finance point of view so that we all agree and make sure that there's no dissension. So no matter what you do, there's always this kind of reaction that you've got to be aware of and try to manage. But I found that by doing that, you encourage a lot more people down in the organization to start to think that way. And I would talk about it at every leadership meeting I participated in. And I was in 2 or 3 a month. And I'd go and spend an hour with all the people who were coming in for leadership training to try to explain some of this. You do that long enough, you start to, let's say, increase your odds that it'll happen.
I'm going to jump in if you don't mind, Chris. It sounds, Dave, it sounds like you're kind of a perfect chairman. I mean, it's a very, in the boardroom, I can see that being.
Well, certainly that's what I tell the Vertiv folks.
Yeah. and publicly, Rob has talked about how you sort of sit back and you have the last word, but you're not super active. You let everyone else talk. But I'm kind of curious, your transition from being a manager, talking to the board, to being the board now, and what are the major sort of differences? But most importantly, I think what's really cool about you is you acted like an owner operator. You acted like a founder-led management team. And how do you do that when the management team doesn't actually have 1/3 of the shares outstanding, but they act as if they do? How do you inculcate that?
Yeah, well, I guess I'd have to start first with myself, is that whatever I was in, I tended to have a lot of ownership. So even with Honeywell, I had a lot of stock options, and I always insisted on stock options versus restricted stock units, because I felt RSUs were a bad idea because they protected your downside and might limit your upside, so you didn't end up making a lot of money. But even worse was the effect that, okay, even if I don't do a great job, I got something.
Right.
I just think that's a bad dynamic. So I liked being able to look all my people in the eye, at my leaders in the eye, and say, look, if we don't do a good job here, you get nothing. So it behooves all of us to make sure that we're all doing the right thing.
Yep.
To get that sense of ownership further down in the organization, I would say the first mistake leaders make is thinking that everybody's interested in the stock price. And they are maybe the top level folks because they've got enough of it there. Even when you get to the next level, that starts to lose its allure. And when you get down to the hourly people, I think there's nothing worse than a leader talking about the stock price, and all these hourly folks, and remember, I was one, are sitting there saying, okay, yeah, I like knowing it's in my 401k, but what I really want to know is, am I going to have a job here 5 years from now? You want to get ownership from me? Tell me how to make sure that I'm going to have that kind of future for myself. And that's why we worked very hard at trying to make sure people understood what they could do to create more self-fulfilling work and have it advance their desire, which was to have a job. And if you look at something like, we had the Honeywell operating system, now the Vertiv operating system. If you're in a manufacturing company, half your people are in manufacturing. So the best way to motivate them and to have them feel that sense of ownership is to feel like they can control something. And what they can control is the work they're doing. And if they start to know, I can have an impact here on what's occurring around me, I'm not just a pair of hands. People actually want to know what I think. They are willing to act on the things that I say. And then you end up with 90% of people going home at night, being able to brag to their spouse and kids about what they did that day. And that creates more ownership, that feeling like, okay, I can have an impact here. I like working at this company because I can make a difference. And that seems to me that where you want to go on the ownership side. At the upper level, yeah, you can generally do it with stock and options and stock price, maybe even down to the next level. But it's important as a leader, I think, to recognize that that influence wanes the further down you go in the organization. I'd say the other thing that we did, and ISS and Glass Lewis hate this, but when it came to bonus plans, my comment to everyone was, I will be fair. Whatever the results of the company are, your division, your function, et cetera, I'm going to be fair. And what does that mean? Because ISS and Glass Lewis love it just to be fully quantified. Did you do the calculation? Did you hit your numbers or not? What does that teach people? It teaches them to argue for a shorter yardstick when it comes to what their budget is for the year. Don't measure me with a 36-inch yardstick. I want to be measured with a 30-inch yardstick. Yeah. So I'm going to tell you all the reasons why things can't happen, why it's so bad out there, and they beat their budget down as best they can, so that then without too much effort, they can beat it, and then the bonus calculation is good. I didn't want to reward that kind of behavior. And if you end up with people who, let's say, are blowing past the bonus numbers, what do? They relax. If you have people who are way behind, what do? To hell with it. The year's done, worry about next year. And we'll save it for that. I wanted them striving every single day. And I did that with this concept of fairness and said, okay, if your industry was just a lot better than what we expected, I'm not going to pay you for that. If your industry was a lot worse than we expected, I'm not going to over penalize you for that. If the company went through a recession and, okay, we did very well overall, but we ended up with a lot of layoffs, furloughs, et cetera, I'm not going to pay you big bonuses for that because that's not fair to everybody. And that concept of fairness, which is tougher to measure, I think is just really important in human nature. And think of it this way. If you get a 20% increase in your bonus, you probably feel pretty good about it until you find out that the guy in the cubicle next to you, who you think of as a peer, got a 25% increase. Now you're pissed. And that concept of fairness just ends up being really important, I think, to human beings. Now, like I said, all the comp agencies hate it because they want to be able to see the mechanics, and really, I don't think they have a clue about human nature. But that's what we did at Honeywell, and that's what we're doing at Vertiv.
Right, that's perfect. And I think I'd love to dive in from that into some of the lessons in the book that obviously came out of Honeywell and GE, and that is managing these conflicting dualities, right? And from when you read it and you hear it, it's so logical. But there's so many managers who always think it's either or just don't do it because I guess it's too hard. And I think you even told the story on one of the conference calls that the CFO of Vertiv didn't really believe in keeping fixed costs flat, or you had to prove it to him. And so I would just love to understand why it is that, something that seems so logical is not often used really out there.
Yeah, I would start with that none of us are trained to think that way. And you might have heard me say, even if you go watch the movie City Slickers with Jack Palance and Billy Crystal, what's his big point all the time? It's just one thing. Figure out what that one thing is. And it's kind of consistent with human nature. I mean, how many times have you been asked, say by one of your own folks, well, boss, you can have it right or you can have it fast. Which way do you want it? Or what's the one thing you want me to do? And it's an easy thing for us all to fall into because as human beings, it's easier for us. We don't have to think as much. We just know focus on that one thing. So I first kind of stumbled across this in what for me was an original discovery about 30 years ago when I had to run an inventory reduction task force And I knew nothing about inventory. I was the CFO of the appliance division at the time. And but the thing I did start with is that, okay, I've never seen one of these things be successful. If we're going to fail, we're going to fail differently. So how do we need to think about this? And this kind of grizzled manufacturing guy, who I thought was old at the time because he was 60, said, well, they always fall apart because delivery gets bad, customers complain, Salesforce complains, inventory comes back. So we started talking about it, said, okay, well, we need to measure both. And I got to admit, I was irritated by it at first because I thought, no, we're here to reduce inventory. I don't want to get hung up on this other thing. But it was the best decision we ever made, because then it caused us to start looking at what's the root cause we can work on that accomplishes both. Once I started thinking this way, I started seeing it everywhere. And things like, okay, do you want to cut all your internal functional costs, or do you want to have great customer service internally? Do you want to have high margins and prices, or do you want to have big volumes? Do you want people closest to the action empowered for quick decisions, or do you want to have good control so nothing bad happens? And once you start thinking that way, you see it everywhere, and you realize that you've always got to accomplish these two things. In fact, originally I called it my any ninny theory, and it was any ninny can do one thing. The trick is to figure out how to do both. Well, it took me a few years before I realized it was not an original discovery. I don't know how many centuries old the discovery might be, but it certainly predated me. So which got me to the next question, which is the one you mentioned, is, well, if it's so apparent that it works, why doesn't everybody do it? And the answer comes down to exactly what you said, is it's hard. And that's why the first chapter in the book is entitled Banishing Intellectual Laziness, because that's what that is. It stops people from, if you don't do it, what you end up with is people not feeling like they have to think this way, and it's more complicated. But if you can do it and figure out what that root cause is, man, you just end up in a significantly better spot. We even did stuff like the HR team. They were measuring themselves on time to fill jobs, and managers, general managers wanted that. Said, we got to get these positions filled. But what's the implicit assumption there? That you're hiring great people. Well, if you end up with this focus on just this one metric without a countervailing metric, yeah, you'll get jobs filled, but you're not going to be all that happy with them. So we created this survey of every hiring manager to say, at 3 months and at 12 months, are you happy with the person that we were able to find for you? And at the same time that we were expecting time to fill to decrease, we expected the quality that people that we were hiring to increase. Once you start looking for it, you find it everywhere, but most people are not trained to look for it.
Right. Yeah, that's totally fair. And so when we think about, maybe quickly just switching to Vertiv here, when it was apparent to us that, or you guys are kind of out there 500 basis points versus peers, and some of the pushback we got, when doing some of our calls and diligence on the company was, this has been run by PE, this was run by a good business before. Like, how can, Dave and the team come in and all of a sudden find 500, 1,000 basis points kind of here? So would love sort of your view on that. Now, what did you come in and see that, others haven't necessarily?
Well, I think you have to start first with investor insight. And one of the things that has struck me about investors is that as analytical and objective as they may think they are, emotion still plays hugely into investor decisions. And I don't think they even all recognize it themselves, because they'll just get hooked on that same kind of simple thing, like you just said. Well, it was already run by a good company. Well, was it really a good company, or had it been a good company? And was it a good company only in certain places where its philosophy applied, and maybe not so great in others? I saw very few investors ever look at it that way. Very few. Platinum did buy it, and I've spoken very highly of their ownership because they really did look at it differently and say, okay, we're going to have to invest here in order to recover ground. And they did a few things, but at the end of the day, one of the other things that has really struck me is that I haven't run into a single PE firm yet. And I don't know if we've got any PE firms in the audience today, so hopefully they won't take offense at this, but all of them talk about how they operationally improve the businesses. And, I'm sure that's true to some extent, but at least in my experience, it's nowhere near as true as it can be if you really do focus and have an understanding on operations. And I think there's sometimes a feeling that, well, you just go hire that. You hire a good CEO and everything happens. Well, you can hire good CEOs who still don't really know everything that needs to happen there. And that expertise is tougher to come by than people may think. And even if you were to look at the, S&P 500 CEOs, I think you'd find there's a standard distribution there like there is in anything else. And the difference between the person on the far right of that tail versus the far left or in the middle makes quite a difference. And I've kind of likened it to if you've got a wide receiver who can run the 40 in we'll say 4.2 versus another one who can the defender who can run it in 4.3. I'm sorry, if you've got two, I should say this, if you've got two wide receivers, one can run in 4.2, one can run in 4.4, 4.3. Well, one of them catches the pass and wins the Super Bowl. The other one gets intercepted. And it looks like a small difference, 1 or 2 tenths of a second, but it makes a huge difference when you're actually going to execute. Business is no different. Operations is no different.
And then jumping off of after taking some of those costs out by whittling down the business processes, almost at a unit level there, you very much talk about planting seeds for the future through increased levels of R&D spending. You did it at Honeywell, which allowed the acceleration through 0809, and you're definitely starting to do that here at Vertiv. But the question I sort of have is how do you know where the right investment should be made prospectively looking 3 to 5 years forward? I mean, it's always difficult to sort of forecast where the future is going. Everyone wants to tell you where the future is going, but you don't necessarily know. So, how do you sort of put capital to work to play where the puck is going?
Yeah. Well, first of all, you touched on one of my favorite concepts, this idea of holding fixed costs constant while you grow. And it's another one where if you just do the math like David Fallon did, because he initially didn't believe it could be our CFO, because he wanted to prove it to himself, and he was shocked at what the answer was when he did it. It does work, but it's difficult to do because it means if you're going to hold your fixed costs constant, you're still going to give people raises, because 60 to 90% of fixed costs is people, means you need to figure out a way to take out, say, 3% of people a year. You need to become a lot more productive than you were, and you only do that through process improvement. And you never saw me do something like take a 20,000 person restructuring charge. Analysts love it. They look at it and go, oh my God, the earnings are going to be great. The thing they don't look at in there is, okay, what kind of disruption is that going to cause? They just assume that that's just people kind of sitting around doing nothing. Well, they are doing something. It may not be worth 40 hours worth of comp, but they're doing something. And unless you know what those things are, you're going to run into trouble. When it comes to where do you invest, this is where having an industry knowledgeable team makes a big difference. And they won't get it all right. I mean, there will be things that you'll spend money on that just don't work out, and you got to abandon it. But in general, that's what you want your team figuring out, is where are those places where you ought to put your money. And when I look at Honeywell, for example, I felt like clearly we could be more global. And it's a very easy thing to do, to just say, okay, be more global. So you could just go hire a bunch of people in all these different countries. And I thought, no, if we just go and hire a bunch of people in a bunch of countries, then we're going to end up firing a bunch of people in a bunch of countries. We're going to focus on China and India, because those two together are about 40% of the world's population. They're growing. If we can get those right, then everything we do is going to be transferable. So again, we just really focused. I believed in globalization and prospects there, but we focused and said, just China, just India. Yeah, I'm not against picking up sales. We ought to have salespeople and so on, but I'm not going to spend all my time and the organization's time on all those places. I'll visit and meet customers and so on, but the focus is going to be China and India, and of course, it paid off very well for us. Same thing happens in R&D, and this is where I say just increasing R&D doesn't mean you're going to get great results. Because along with increasing R&D, you've got to improve your processes, not just for how quickly can you get something to the system, but the whole ideation side of it. How do you develop 100 good ideas so that the 12 you pick that you're going to finance make the most sense and have the greatest chance of paying off? And then I'm fond of saying, you don't want milestones for those things, you want inch stones. And you want to be able to track all along, okay, is this working the way we think it is? Is it going to pay off the way we think it is? And at various points along the development process, you run into these kiss or kill decisions, and you just have to make a decision on whether you're going to keep it or whether you're going to end it. And you don't get it all 100% correct. I mean, there's no doubt there's wasted money in there, but as John Wanamaker said about advertising a long time ago, I know half my money in advertising is wasted. I just don't know which half. So you do run into that, but overall, if you run the process the way I was just talking about, you're going to end up with a good result.
Dave, can I jump in and ask, if I think about the 3-year sort of horizon for Vertiv and think about where you want to be, I look at enterprise, and it's half the business, and it's sort of post growth. I mean, it might recover, it'll recover, right, from COVID, but it's not super attractive, right? So how do you think about maybe leaning more into hyper and colo, or maybe you don't because of the margin profile and is offset by the growth that you see there? How do you think about that portfolio? Because I think that's one of the only hangups I think that's keeping Vertiv back from sort of becoming, a steady compounder in today's worlds,
Yeah. Well, first of all, our Vertiv horizon goes far beyond 3 years. So as you might imagine, I look at this as going to be good for a long time. And this is where I think it's important to start first with what I've always referred to as the macro trends in an industry. And if data growth is 20% a year, and there's a feeling that, okay, the cloud is just this place out there. And I don't think everybody always recognizes, okay, no matter how you do it, that data has to be stored somewhere. And that means there's a data center. Well, data centers are going to continue to grow, maybe not at 20%, because technology improvements will be there to make them more efficient. But I have a tough time envisioning a future, at least for the rest of my lifetime, where data isn't growing 20% a year, whether it's consumer, industrial, B2B. It's just going to keep growing. That's not going to change. So to your point on mix, hyper versus enterprise, yes, the contribution margin, no doubt, higher on the enterprise side. That being said, the contribution margin rate is significantly higher than what our operating margin rate is. And if you're holding fixed costs flat and growing sales, you just do the math, and the margin fall through continues to be significant. So I viewed it as, yeah, okay, we all would prefer not to have negative mix changes, but I don't see that as alarming or a problem. And Rob and his team had already started working on growing in hyper and colo. which we've accelerated because I think that's a phenomenal place to be. It's growing great. Contribution margins are great. So why not do it? On the other side of it, to your point, is an area with even higher contribution margin rates that we're just starting on, and that's anything having to do with edge or distribution or channel, it's often referred to. That's an offset to the, we'll say, the mix issue that you just described on the hyper side. So I found this whole, because I went through this a lot in the pipe discussions, is it's an, I'd say, overly facile analysis that just says hyper is growing, so that's going to damage a company like Vertiv. And it just doesn't show, I'd say, the thought penetration that is required to really understand, okay, what's the actual math here? Even if it works out that way, does the math hurt? And it doesn't. Now, you could argue, okay, if you got that same kind of growth, but it was all enterprise, would the numbers be even better? The answer would be yes, but that's not one of the choices. So you have to say, okay, given where the growth is on both the edge and channel and on the positive side, and hyper on the, say, lower contribution margin side, that's still a pretty darn good recipe overall.
So I'd love to, before I forget, if we have some very smart people on the line, so if you guys want to raise hands or type in a question, I can either unmute you or ask your question. But so related to that, Dave, I'm just wondering, with the balance sheet leverage, the leverage ratio coming down now, and I think also it's a very different profile of company going from Honeywell down to like a small little fish, not a minnow, but not a whale, right? How can you, I mean, what is your risk appetite? I mean, do you think it's time to start stepping on the gas in terms of really developing with capital, with M&A, right? Or do you think it's still just, you still need to kind of continue to get your sort of, I always call it the Danaher business model, like the Kaizen strategy that you've got going? Is it still, you still want to consolidate that position? Where are you thinking right now on your risk tolerance?
Oh, we've always said we're going to pursue both, and we are pursuing both. The first one is you never want to let up on your internal operations, because that's the primary driver. And just like with any strategic planning we ever did with Honeywell, same thing we do with Vertiv, we count on no acquisitions. So this is, can we deliver the kind of investor profile, performance profile we want with no acquisitions? That's where you have to start. And what I always said, I've used this line a lot, is problems and opportunities choose their own timing. So you can say, okay, at this point, this is where I do an acquisition, because then I'll have the money. But if there's no deal that makes sense, then I sure as hell don't want the money burning a hole in my pocket that I got to do it. Same sort of thing, if an opportunity had presented itself even this year, I would have found a way to do it. And Rob would have been right there, and so would the board, because we just said, too good to pass up. Well, yeah, okay, wish it was a year from now, but we'll do it. Well, we're in a much better position now. As you know, we've got over $1 billion in liquidity, and hopefully reinforce this to investors. Back in April or May, when I told them to stop worrying, liquidity wasn't an issue. They say, okay, well, maybe he actually did know what he was talking about. So we've got clearly more fuel to be able to use if we want to. And we're going to keep looking like we always did. And Gary Niederprum and Rob are always talking to companies to see when something might be right. And if we find something and it's right, and the price is right, price matters, then we'll do it. If we don't, then we won't. And I always hate committing to any kind of timeline, because, well, it ends up, I think, being a not just self-fulfilling, but painful prophecy, because then you feel driven to do something. I just think that's a bad dynamic to actually running a business smartly. Absolutely. So yes, both organic and inorganic are going to play for us in the future. And we do have the firepower to be able to do something now if we wanted to. But I don't feel compelled to do something. And I know Rob and I know the board doesn't. But if the right opportunity does, yes, we would do something.
Right, and just sort of maybe jumping off on that in the capital allocation decision is something you obviously did spin-offs and purchasing assets at Honeywell, and we think it will become a part of the Vertiv playbook. But I mean, maybe you could talk about specific metrics or qualities. You know, is it a financial decision only, or is it a right fit for the company at that right point in time as well? I mean, how do you balance those two things, you know, to getting it there?
Well, for me, it still comes down to this accomplishing two seemingly conflicting things at the same time. We're going to want to do both. So I always start with the acronym for it that we always use was GPGI, and that's that we want a great position in a good industry, and start with that. Then the second look is, can I differentiate with technology? And I picked technology in Honeywell just because it was a technology company. It's just the way they thought. Even if you could differentiate with brand, we weren't brand guys. So it wasn't going to particularly work for us. Vertiv, I would say, is much the same way. The technology differentiation matters, and that's where you can keep an edge and keep your prices and margin rates high. And by investing in R&D, you can keep that stay ahead on the technology side. So I think, Beck, I know Rob would say the same thing, is those are the places he likes. So I'd always start with that. And even an acquisition that was brought into the company, and as you know, at Honeywell, we did 100 acquisitions, 70 divestitures. Total sales value of that was $23.5 billion on a company that started at $22 billion. So a significant amount of change. And I think proof that acquisitions can drive value, because as you know, we beat the S&P 500 by 2.5x over 16 years, and acquisitions and divestitures absolutely played a role. So I do think it is a way to add value. But I would always start the discussion by when somebody brought something in, was saying, well, why is this a good industry? And they'd have to prove to me why it was a good industry. And there's a number of things we'd look at. How fragmented was it? Were people profitable in the industry? How fast was it growing? Were there any potential disruptors in the future? So we would go through all of that. Then, okay, is this a good position, or are we buying the number 7 guy just because we like this area? And if we are buying the number 7 guy, is there a way to buy the number 5, 4, 3 guys so that we become like the number 2 or number 1 in the industry? Both of which we did successfully. Discussion would always start there. Then we would get into the financials and say, okay, based on the integration plan and the savings we think we could generate, and I allowed no sales synergies to be included. I wanted to know what they were, but only cost synergies were allowed in the valuation model. Can we hit our financial criteria, which were accretive in the second year? Because in an industrial company, no matter how many people say they're accretive in the first year, it just means they're not counting everything, or they're using the incremental cost of interest, not the kind of blended cost. Second one was I wanted IRR above 10%, and I never changed it, never got into the weighted cost of capital, which I thought that's like how many angels can dance on the head of a pin. I mean, when I used to have a bank come in and say something like, well, you know, we've done the analysis and your cost of capital right now is 8.2%, and this deal can be done at 8.4%, so it'll be good for share owners. I say, well, that's ridiculous. And plus, you can make IRR dance if you want to, with just what do you assume for residual value. But I still wanted to know that with reasonable assumptions, it would be above 10%. Then the last and toughest one was I wanted a 10% ROI in the 5th year. And if you have a 20% ROI company, that sounds, boy, this is just going to be dilutive overall. But you'd be surprised if you're counting everything, how difficult that 10% ROI is. And in general, we always beat it. We did better than that. And that's why our ROI as a company ended up over 20%. So it was always the two that we looked at. And the fallacy I thought big companies oftentimes had with acquisitions was, this is my strategy, so I need to be willing to pay for it. And that to me is a great way. I mean, as a seller, those are the kind of buyers I wanted to run into, because that means that somebody's willing to do something stupid. I always felt like price was a fundamental part of strategy. And it's why I never found an easy way to get into, with any size, into the water industry or medical products, both of which I thought we could have done very well with. But prices were just so crazy that it just was going to be difficult to pay. So the answer is both. You always have to look at both.
Right. And I feel a little like, I'm dirty asking this question because the topic of the day is ESG, right? And, the data center business, generally, it takes up 1% of electricity worldwide. And, you're on the side of helping, become more efficient on that. But, so you have that partnership with Honeywell, but where else can you lead in this way to sort of, showcase could potentially be an ESG kind of company to help help the world?
Well, at the end of the day, data centers aren't going away. And if people start to say, okay, well, data centers are bad, the alternative to revolution is not going to be good. So there's no way around data centers at this point, and there's no technology out there that says they're going to disappear. So the answer has to be exactly what you just said, is, well, how do you make them more energy efficient overall? And there we've got a lot of projects working with our customers, because you still want the performance of the data center, but you want to make sure that you do it in a way that's as environmentally responsible as possible. And so we're having actually great discussions with them. I think it's going to be a great place for us to add value for our customers. And yes, we've got a number of projects going. I prefer not to go into any of them. I would just say that this is top of our list and has been since I got to Vertiv a year ago.
Got it. And maybe something recently that just sort of happened, obviously on the earnings call, was sort of quote unquote cleaning up the reporting structure, and reporting, non-adjusted numbers. And in a world where, every single ad back for every company seems to be, in vogue, and everyone adds it. Why did you find it so important to sort of lead, by example, sort of with Vertiv? And I think you did a lot of ways with Honeywell as well.
Also, Dave, you're acting like it wasn't even a SPAC. You're behaving very differently from the rest of the SPAC universe right now.
I'd say, two things to answer in there then. I felt like for both investors and for management, that whole idea of ad backs is a bad phenomenon, because that starts to run into this kind of free money side. And as long as it's an ad back, well, it's not really cash or expense. And of course, we both know it is. And if you're trying to run a company and build it for the long term, I think you want to get all that stuff out so that people look at it and go, oh, okay, this is the all in, whether it's a one-time item or not. You still have to think about it because it's part of running a business. If you owned your own business, you certainly wouldn't look at it that way. You'd want to understand it all in. The only adjustment we did allow was for intangible amortization, just because it's such a big non-cash number that it doesn't make sense, and it's a good thing to have, actually, that we wanted to make sure that we adjusted for that. Everything else said, I don't want the management team any longer thinking about ad backs. It's spending. You can choose where you want to spend the money. You can choose that makes sense, but we don't want management to think that way, and we don't want to be in a position where we're diluting and confusing investors. And I predicted we'd take a hit that day, even with good numbers, just because as soon as investors see a change like that, they go, wait a minute, their heads explode and they sell and figure it out afterwards. And that's pretty much what happened. You saw we recovered pretty quickly. When it comes to SPACs, I think there's two values to SPACs. The first one is that ability to get to market quicker, forward projections, the ability for a seller to take out more cash. But really any SPAC can do that. And I've kind of said, if I were a seller, I would conduct a SPAC off and say, okay, 5 of you come on in. Yeah, that term amuses me. That's why I use it. So I would say, I'd have 5 of you come in and say, okay, what price are you willing to do this for? And that's why it's so important to have that second aspect. And that's what we were trying to do. What I was trying to do with Goldman was to say, we're going to improve the operations of this so that, yes, if you did it with somebody else, maybe the stock would sell at 13. But if you do it with this person and you're able to actually improve the company overall because of the things you're able to do, now you have something that trades in the 20s. And that's worth significantly more. That second aspect is still missing, I'd say, in over 90% of SPACs. And getting back to the, maybe more, and getting back to the point at the beginning is there's a feeling like, well, you just hire that's just something you hire. And you realize, no, actually, it's a little more difficult than that. And there's that like 4-2, 4-3, 40-yard dash kind of argument in there again.
Yeah, and I want to be cognizant of your time here, so I kind of got a follow last question, and it is sort of, you know, related to the transition to Vertiv, which was after your wonderful career at Honeywell, you could have ridden off in the sunset. You could have just, you know, hung out in Florida or gone fly fishing. But sort of what drives you, or what drove you to, you know, come back, do this transaction, get involved, you know, in this business? I mean, is it just your passion, or what, you know, what is it that, you know, has you coming in doing this every day?
Well, I went from being a screw off before the birth of my son, scaring the bejesus out of me, to finding out that I like working. I enjoy it, and I like building stuff, and I just like seeing something just get better and better because of my involvement with it, and I can see where it's going to go, and I get my jollies from that. And there's other things I like to do. I like to hunt, fish, ski, scuba. But if I had to do that 100% of the time, I know it wouldn't be as much fun. Part of the fun is being able to know I can't do it all the time. And there's other things that I'm doing, like work, which I find very fulfilling. I always said, I thought, and this gets back to the kind of the motivation and ownership side again, that if work is fulfilling, then it's fun to do. Yes, there's aggravations and stuff that go along with it. But overall, that setting a goal, striving for the goal, achieving the goal, and your first step after that is to say, okay, what's next? That's very fulfilling to me. And I think it's part of the human condition for most people. And I have no desire to hang up my spikes yet when there's so much left to do. There's a lot of fun stuff going on out there, and I like being a part of it.
I was almost going to ask Dave. I mean, you have a lot of energy still, and you have it seems to me like a lot of different businesses could use your guidance. Do you plan to maybe do this in a different vertical and spread your time a little bit?
Well, I would say it's too early to declare, but I would say Vertiv is in a very good position now. And I always said after that initial phase where I'd be devoting like 100% of my time to it, that I'd get to that point where it only took a day a week, which is pretty much where we are now. And the team is just doing a great job of executing all the things we talked about. And I couldn't think more highly of Rob Johnson and the team he's assembled. So it just doesn't take as much of my time as it did in the past. So yes, I'm absolutely looking at what's next and what I might do. And like I said, it's too early to declare what that'll be, but I can promise you that I'm certainly working on it.
Looking forward to it for sure. Chris, do you have any last ones?
No, I think the last thing maybe just for me is a very, you know, cliche question, but it's sort of, what was the best advice you ever received that sort of stuck with you that you could, you know, sort of relate to us?
Yeah, I guess I'd go to two items. The first one we already touched on, and that's from my mom and dad about being a leader and not a follower. The second one was I got a great piece of advice from a guy about 20, 25 years ago. that said, if somebody's talking to you or asking a question, wait 3 seconds after the question is asked before you answer. And the reason for that is all of us, especially if you've got, let's say, some kind of brain power, you can listen like 3 or 4 times faster than you can speak. So what are you doing while somebody else is talking? You're already thinking about your answer. Whereas if you take the time to say, no, I'm not going to think about it until 3 seconds afterwards, I'm actually going to listen to what they say. You find yourself understanding a lot more about where that person is coming from, not just based on what they said, but how they might have said it and what they didn't say. And it just opens up a whole new world for you when it comes to, are you really listening? Now, there are some people who will go on forever, and yes, you may want to cut them off at some point. But at the end of the day, I thought that was a really good piece of advice, because I had that same tendency that a lot of us have, is you're thinking about your answer halfway through the question because you already know where they're going. I actually saw a CEO interviewed once who apparently had that same problem. And he maintained that it was because a boss had told him once that he was just so much smarter than everybody else that his brain worked that much faster. And I thought, well, I think you guys kind of got the wrong lesson from that one. But at the end of the day, it's a nice piece of advice. And I'd recommend it to anybody. It does work. It takes a little bit of work, a little bit of effort, but it does work.
Awesome. Well, really appreciate your time. Thanks for being with us today and going into all these details and really helping everyone on here. So safe flight, and we'll be continuing to watch Vertiv deliver on everything you've kind of built there and planting the seeds for the future.
I just want to add, sorry, go ahead, Dave.
I was going to say thank you for your ownership, and hopefully you'll send out copies of my book to everyone and say, okay, now this is a must read.
We already have for Christmas. But I was just going to say, Dave, it's really an honor to be able to co-invest with you and have your guidance and leadership here. One of our attendees actually just said must read on your book, but it really is actually an honor to be able to co-invest with you. So I mean, thanks for being able to take us little investors along for the ride, and it's one of our favorite stocks right now. So really appreciate your time and thoroughness here.
Well, the ride will continue, and when the stock dropped to 5, when everybody was panicking, I was desperate to buy more, but because of our blackout period, I was precluded from doing it. It was killed me, but oh well. Sometimes you gotta follow the rules.
Sorry.
Yeah, well, you were smart. You were very smart. That's one you should be very proud of, because everybody else was panicking, and again with no insight, just pure emotion, and you were smart. Independent thinking.
Broken clock twice a day. But anyway, thank you very much, Dave. It's really nice to meet you.
Thank you, Dave.
Thank you for the invitation. It was fun.
Bye, guys.
Have a
See you
great day.
guys.
Cheers.